Hi all, this is Akshara Menon from PMS Weather, welcoming you to the Friday webinar on Sector Insights for Optimizing Growth and Value in India's Road to $5 trillion economy. In this webinar, participants can expect to learn about the broader opportunities provided by the GDP expansion, including historical precedents that highlight significant growth periods. We will explore GDP reconsumption opportunities with focus on the potential boost to manufacturing and services sectors. Understanding the key growth engines such as consumption, financials, industrials, and the Capex cycle will be crucial. We'll also discuss strategies for optimal positioning portfolios using sector and company insights during this high growth period, while considering the current valuations. Finally, we'll cover how to create alpha through the balanced portfolio of growth and value stocks, ensuring overall portfolio valuation is monitored. To elaborate more, we have our speaker for the day, Mr. Aniruddha Sarkar, the CIO and Portfolio Manager at Quest Investment Advisors since Feb 2020. With over 17 years of experience in capital markets, he has successfully managed investments across PMS, AIF, and advisory businesses. Known for his key insight into sector themes, Mr. Sarkar has a track record of identifying emerging trends early in the life cycle. Before joining Quest, he has spent 11 years with IIFL Group companies where he managed IIFL Multicap PMS, delivering industry-leading performance recognized in 2019. Mr. Sarkar holds a bachelor degree in commerce and MBA in finance. Thank you for joining us today, sir.
Yeah, thank you, Akshara, for having me here on this evening, and I'm looking forward for having a very good engagement with you and your investors. I'll take a deviation from the sequence of pointers which you mentioned. Basically, what I'll do is I'll capture everything, but I'll basically try to build the context that which are the sectors, because I know that when I meet any investor, the first thing they ask is, which sectors to bet on. But, that's a very easy job. So I'll not come to the sectors to bet on immediately. I'll talk about that why a different style of management is important in the market, all the more in a market like India. And then I'll build a context that why India will be doing well. And basically, as India does well, which are the sectors to bet on. So that will be kind of the broad context. So basically, what you can expect in the next half an hour is these pointers. I would want to extend a warm welcome to all the attendees on this call. So these are the broad 4 headings on which I'll talk about. And I've kept the interesting part, which is which sectors to bet on at the end. Because we need to build the context that why those sectors are going to do well as we go along. Coming to the first part, which is why active management is important. Now, this is something which I keep hearing from investors that, is active management important? Isn't it a good thing to just buy and hold companies for the long run? I would say that the way management of money has happened in India has seen a drastic change over the years. In fact, the pace of, I would say, the events which have been driving equity markets, corporate earnings, valuations, all that has taken a massive change post the COVID. And I would say, practically, I was just discussing with Akshara that in the last 4.5 years, we have practically seen everything that you can think of. Whether it's the pandemic, wherein for almost 6 months, people are sitting at home. You had your interest rates going up, inflation going up at 40-year highs. You had the 2 wars. You had earnings taking a big hit on the margins. You had your oil prices going down below $1. Practically everything you can think of has happened. So the dynamics of the factors driving the markets has been very, very they have been changing very fast, and that is where active management has become very important. Also, the other aspect is the amount of money which is entering the market, both from the domestic side and from the international side. That has gone up multifold, and all the more that is driving the market a lot, and hence actively keeping a tab on which are the sectors to bet on, which are the sectors to avoid has become very, very important. One thing which I'll mention, which is a very important fact. In fact, this is a debate which we have had a lot in the past about active versus passive. Now, when I talk about passive, it is basically your ETFs I'm talking about. I have nothing against the ETFs, but I would say a passive style of management makes a lot of sense in a matured market, or I would say in an efficient, matured market, which is like the developed markets of the US and Europe. A passive style of investing makes a lot of sense. I would say in an emerging market like India, active style of management definitely adds a lot of alpha. So I've been managing for the last 10 years, and I have seen the type of alpha of almost 7.5% alpha over the benchmark. Annualized alpha over the benchmark has been achieved. So definitely, I would attribute that to the active style of management. Another interesting part of active style of management is that when you're investing in a passive fund, typically the index, it adds a company after it has done well, and it removes a company once it is not doing well. On the other hand, by active style, you have to be ahead of the curve. You are able to identify the right sectors, identify the right companies within those sectors, and hence you have to enter before others enter. That is where the active style gives you an edge over the passive style. Over the next couple of slides, I'll basically talk about these three headings, which is about the three styles. I would say what really identifies an active style and what is required as of today in India, as India grows from the current size to the next 5 trillion. One is sector rotation, second is market cap rotation, and third is balancing the value and the growth style. The whole idea about sector rotation is about catching the business cycles. Now, business cycles, I'm sure all of you have heard multiple presentations, multiple, I would say, investment articles on business cycles. I'll not get in depth into it, but basically, just to give you a kind of a crux, there are 4 phases of a business cycle: your expansion, peak, your expansion, the peak, the slowdown, and the trough. Ideally, you'll find that there is no clear demarcation between one phase and the other. Each phase, it merges into the other. So it's not like, you will find an expansion phase happening and that ends, and then the peak starts, and then that ends, and then the slowdown starts. Each phase merges into the other. These are the pointers, which I would say the factors which I've highlighted over here in the boxes, which kind of gives you an indication that is this phase expansion, peak, slowdown, or the trough, whether it's about the trade growth, about the interest rate cycle, about employment, economic activity, or the Capex cycle. These are the factors which kind of are visible in each of these. Now, the reason why sector rotation has become important, as I mentioned, is because economic cycles are inevitable part of our economy. If you look at the last 40, 50 years of the US market, the European markets, Japanese market, the Chinese market, or the Indian markets, you'll find that economic cycles are a very, very inherent part of the way the market works. Economic cycles, they lead to the earning cycles, and earning cycles, they lead to the valuation cycle. Now, that is where I say that one needs to capture the valuation cycle of companies, which basically means you enter at the bottom of the economic cycle, because economic cycles leads to the earning cycles leads to the valuation cycle. At the bottom of the economic cycle, your earnings are the weakest, and that is the time you get the best valuation. At the top of the business cycle, you get your earnings at the best, your ROEs, margins, everything are at its best, and that is the time everybody wants to be there, and that is the time your valuations are also very expensive. The real idea will be what we all know. You should be entering when nobody wants to be buying there, and you should be exiting when everybody wants to be there. Now, that is the crux of sector rotation, which I keep saying that it's not just important which sectors you're getting into, it is more important which sectors you're exiting from and when. Now, any of you attendees who would have attended any of my earlier interactions, they would be very acquainted with this particular slide. I keep showing this slide again and again, just to harp on the fact that this is a very inevitable part of the way the market works. Now, if I look at these numbers are basically the returns of each of these indices in each of these years. The numbers in green are the top 3 performing sectors, and the numbers in pink are the bottom 3 performing sectors in each of the years. Now, this shows that there is no sector which has been immune from the good times and the bad times. Typically, the thought comes that it would be the defensives like consumer, pharma, IT, etc., which would always do well. And it would be the cyclicals like your metals, capital goods, autos, the real estate, which will go through the good time and bad time. What you see is that even defensives, or I would say the cyclicals, they all have their good times and bad times. The bottom 3 line basically shows the market cap and how they would have performed over time. Now, this shows that there are years when the large cap does better. We all know this, that there are years when the large caps have done better than the small and mid caps. And there are years when the small and mid cap has done better than the large caps. So this basically shows that you need to be flexible between the market caps also. The two pointers which we just covered, one is sector rotation, which is one part of the active style of management, and the second part is the market cap rotation, which both of this you get a glimpse in the slide that why it is very important. The third part of active style of management is about balancing the value and the growth style. Now, we all know that there are two parts of the market. One is the value part of the market. The value investors typically will not touch your expensive companies. They will not touch companies which are in the consumer discretionary space or in the FMCG space, which are very expensive. Or for that matter, many of the NBFCs and the private banks, value guys will typically avoid that. The growth investors will typically avoid PSUs. Growth investors will avoid energy companies, defense companies, power companies. Now, we have seen over the last 4.5 years or 5 years that there are times when the growth part of the market has done well, and there are times when the value part of the market has done well. So ideally, you need to be very, very flexible between buying both into the value and the growth part. Now, when I say value, you buy into PSUs, power stocks, energy stocks, oil and marketing, capital goods, engineering companies. And when you're buying into the growth companies, you need to buy into your urban consumption, semi-urban consumption, FMCG, consumer discretionary, even IT for that matter. As you will see in the subsequent slides, the sectors which I'm bullish on, they actually encompass the entire gamut of value and the growth. There are sectors over there which are in the value part of the market, and there are sectors over there which are in the growth part of the market. So this are, I would say, the broad three headings for capturing the India growth story. You can't be fixated on any one style. You need to be flexible with the sectors. You can't be fixated on market cap. So you need to be flexible on the market caps also between large, mid, and small. And you can't be fixated on value or growth part of the market. You need to be flexible between both value and the growth part of the market. Now, let's come to the second part, which will kind of give you a glimpse of what a multi-decade growth looks like. Now, before we come to India, let's look at some other, I would say, economies and how they have done over that period. The first graph basically shows the German economy. Now, post-World War, the German economy from 1950 to 1969, for those almost 19 years, 20 years, they had almost a 7.5% CAGR growth in their economy. Now, that was called the miracle years. And I would say the foundations of the German engineering, German manufacturing was during that 19 years of the massive growth which they had seen. The second graph basically shows the Japanese economy. Now, Japan, as we all know, again, this was post the Second World War. Japanese economy went through a massive growth of 9.2% annualized economic growth from 1956 to 1973. Now, that was, again, I would say, the foundation of the Japanese engineering and the Japanese manufacturing, which the world is aware of now. So both the upper two charts, the German economy and the Japanese economy, saw a massive growth of almost 7.5 to 9% annualized over a 19-20-year period. And that were the foundations of the German engineering and the Japanese engineering. The bottom graph is what I would say has captured the imagination of everyone over the last 25 to 30 years, which is basically how the Southeast Asia, which is mainly the Chinese economy, how they have grown. From 1982 to 2011, they have grown at almost 10% annualized. And that is what I would say has taken away the big part of the upper two graphs, which is the German manufacturing and the Japanese manufacturing. So these are the three economies which I would say have seen a massive growth of that period. Now, why I'm talking about these three is we need to draw, I would say, how this is going to be very similar to what we are seeing in India. And that is what is going to drive the growth for India over the next 4-5 years. Now, the common factors between these three economies, one is I would say the government has been a very, very strong at the top, and that has helped them to take very strong policy measures. And those were the foundations for the whole manufacturing and the economic growth which they saw over there. So the first factor was that the government was very strong at the top. Second factor which we saw was the demographics. In both these places, the demographics was a big factor, and that was what we saw in the improvement of the labor productivity. and improvement of the labor productivity, large talent pool of the labor is what I would say has driven the manufacturing for these economies. The third part is basically what we are seeing as we speak, and what you saw in China for the last 20, 25 years, what you saw in Japan earlier, was that as GDP grew, manufacturing picked up, exports became a large part of the GDP. And that is something which is, again, what I would say has been the major factor behind Chinese, Japanese, and German economies in the past. And that is what our government, our economy is banking on for the next 10, 20 years. This gives you a glimpse how things change. In fact, why I mentioned this slide is just to show where China was in 2006 and where India is where in 2019-20 and where we are today. In 2006, China's per capita GDP was roughly around $2,100 per capita, which has now grown to almost $13,000. And that gets reflected if you see on the right hand side the way the banking sector has evolved, because financials is again one of the sectors which becomes the foundations of a growing economy. In 1996, if you see over here, the top five banks, they were all German and Japanese. Now, as I mentioned earlier, German and Japanese economy went through a massive growth cycle. That got reflected in the top five banks in the world being German and Japanese banks. I move forward to 2019. The top four are all the Chinese banks. So Chinese banks have replaced all the German and Japanese banks among the top four. Now that is the type of, I would say, outcome which happens in the financial sector once your GDP grows from $2,100 per capita to say $10,000 or $13,000 per capita. Coming to where we are, and this is the more interesting part, which is where can we go from here? Again, we have a huge amount of data to show where India is going to head. 5 trillion in the next couple of years. And by obviously 2047, we have a mission to become a developed economy, but let's not look so far ahead. Let's look at where we can be there in the next 36 to 60 months. Per capita GDP of India in 2019 was exactly where China was in 2006. And post that, we are seeing a good jump of both consumption, imports, exports, and that is going to become the foundations of what lies ahead. Now, the major enablers of, I would say, the 5 trillion, and that enabler will basically be where the growth and the sectors which will be benefiting from that. These are the 5, 6, 7, I would say, the enablers for the growth. First being the regulation, and this is the outcome of a strong government at the top. Now, over the last 10 years, we have seen a very strong government at the top. And obviously now with the elections behind us, there is going to be a continuity of the government at the center. Now, definitely expectations are that there will be a continuity of the policy announcement, continuity of the strong growth drivers being implemented from the government. And obviously in the next 1 week, we'll have the budget and the first 100-day policies also being announced. I think these are the ingredients of where our growth will happen from. And thanks to the focus of the government with regard to supporting the manufacturing sector, which happened during the COVID, and post that with the whole Atmanirbhar Bharat, I think the PLI scheme has been kind of the big game changer, wherein you are seeing a lot of Make in India things happening. This used to be a big tagline earlier, Make in India. But I think from being a tagline, it has transformed to being actual action on the ground. And that is where you are seeing, because of the PLI schemes, a lot of manufacturing happening, job creation happening in different industries and the sectors. The second factor will be obviously, I would say, the focus of the government on infrastructure building. And infrastructure building has the potential to a large capital formation. Government has announced over the years multiple projects like the Bharatmala project, the Sagarmala projects. You have a large infrastructure pipeline of projects to be executed, and that is again going to be a major Capex driver for the country. The reforms on the land, reforms on the labor, these are something which has been pending for a long time. But I think with the government being in place for the next 5 years, you will see a lot of announcements on that side also. Also with regard to the logistics, because the cost of logistics coming down is a very important factor for the movement of goods and services much more freely within the country. And these will be kind of the enabling factors for the growth of India from the current size to the 5 trillion. A big factor is always goes without saying is the demographics. And I think India having the largest working population by 2031, which means in the next 6, 7 years, almost 65% of our population will be in the working population. And that compares very, very large compared to any other country in the world. If you look at the graph on the right hand side, it gives an indication of the median age of India's population compared to some of the large economies. India at almost 29 years is almost half of what the Japanese population is. The median age for Japan is almost 47 years, which is practically you're getting an old economy there. Even for the EU, it is almost 43 years. Both for China and the US, it is around 37 years. So India at 29 is one of the youngest economies in the world, and that is going to be a large factor for manufacturing, for consumption, and for the per capita GDP to continue to grow where it is today. Again, another enabler for India's growth is going to be the cost competitiveness, and that is where I would say India's labor cost, which is right now at 1/3 of China, has been a very strong enabler. PLI has become a success because of the labor cost being very advantageous towards India. Power cost has broadly, I would say, very comparable to what it is in China. But compared to the rest of the world, compared to Europe, compared to America, we are at much, much lower number on the power cost. And with the type of Capex which is happening in the power sector, definitely both on the renewable and the non-renewable side, I think that is something which will continue to see getting better and better. Taxation is again one of the lowest. And I think with the labor productivity improving in India, that's a good indicator of that, manufacturing is going to pick up in the country. This is a very important chart because this shows the composition of India's GDP, what it is now and where it is going to head. We have always heard during our school days that India is an agricultural economy. It's a thing of the past. India continues to be now a very small part of it comes from the agriculture. As you can see, only 19 to 20% comes from the agriculture. Almost 54% comes from the service industry, and service includes everything, not just IT services. You get public service, defense, the real estate, everything comes under that. The important part is this 26%, which is industries. Out of that, around 14% is the manufacturing. Now, this 14% is going to become almost 20 to 22% in the next 3 years. And that is where the big growth is going to come from, because on a size of 4 trillion, if you're going to see almost a 6-7% jump of manufacturing as a percentage of the GDP, that is where the biggest alpha or the delta is going to come from in the economy. India continues to be the fastest growing economy, and not only now. If you see India's growth rate for the last 10 years, you have consistently seen that there has been almost a 4 to 5%, almost a 4% plus minus gap between India's growth rate and the rest of the world. Except for the COVID years, I think we have been there. And if I look at how India ranks on all these parameters, obviously we know about the economic size. With regard to the auto market, we are the third largest auto market in this year. With regard to the power generation, we are the third again. With regard to the number of production of the mobile phones in the country, I think we have seen a massive, massive jump over there in the last couple of years. In fact, in the last 10 years, from being at the 12th, we are now at the second. That is, I would say, a big, big jump by any measure. With regard to the production of the steel, we are the second largest. With regard to innovation, the ease of business doing, I think there has been a big improvement in all those numbers. Innovation 40, definitely we have a big room for improvement. Even for ease of doing business, 63 is not a very happy number, but yes, we can improve from there on also. Now coming to the last part of my discussion, which is which are the sectors I would be betting on. And without keeping it as a big surprise, we have also mentioned it in our initial, I would say, discussions. These, I would say, are going to become the pillars for the next couple of years. And the sectors where we are betting on is manufacturing, consumption, and financial services. Now, all of these three are interlinked. It's not that one can work without the other. Each of these are interlinked. And I would say that manufacturing goes hand in hand with job creation. Job creation goes hand in hand with the consumption, and with consumption goes hand in hand with financials. and financials again goes hand in hand with the manufacturing. So this is kind of, I would say, the three pillars of India's growth story, wherein you'll find because of the government policies, announcements, PLI schemes, the regulatory support, taxation benefits, you will find domestic manufacturing picking up. And that is not something which we are just saying. It is actually there in the numbers. If you look at the share of India's manufacturing in the globe, we have definitely improved in the last 18-20 years. From 1.5%, we are almost at a 3% now, which means that as a percentage wise, we have doubled in the last 18-20 years. But the bigger jump is going to happen as we move ahead. You get an idea of where China was 20 years back and where its share has gone as of now. And the countries which have lost is where they will continue to lose as we speak, which is the EU and the Japanese and the US markets. And that is where India also needs to get its share from. A lot of debates happen that, India can't replace China because China is too big. Everything is much better than India. I would say that we don't need to replace China. We just need to take a small bite from them, and we need to take a big bite from the Europe, Japan, and America. That is where the big bite will happen. Smaller bite will happen from the Chinese economy, and that will take us much higher compared to where we are today. That is where the China plus one and Europe plus one, it works out. Industrials and Capex is supportive of manufacturing. Now, when I say industrials and Capex, it includes both private Capex and the public Capex. If I look at the numbers of both private and public Capex, I think for the last 18 to 24 months, the public Capex is what has been supporting the economy. Over the next 24 to 36 months, it will be the private Capex which will be the big driver. And I would say that if you look at the numbers, definitely private Capex has a large scope for creating jobs. From the current almost 41 to 42 trillion rupees, it will go to almost 116 trillion in the next 6-7 years. That's like a massive jump on absolute numbers of almost 75 to 80 trillion rupees. On the public Capex, you will see almost a 15 trillion rupees addition over the next 6-7 years. And that is again going to be the supportive factor for the private Capex to unfold. The other part is the urban consumption and the semi-urban consumption. Why I'm talking about urban and semi-urban consumption? Because as of now, that is what we are betting on. The rural consumption is something which should start picking up as you see the rural income also improving. On the consumption side, as I mentioned, basically how it happens is it's a kind of, you can say, a big the cycle of manufacturing, industrialization, which leads to the job creation, which again leads to the consumption picking up. Now, if you see, India has been a big consumption country, and I think that is a very big differentiating factor for us compared to, say, Germany or Japan. Now, what happened is India has grown as a domestic consumption story. We have a large pool at our end itself. We are not dependent on exports as of now. Now, that becomes a very big captive pool for any manufacturing on the services or on the production side, wherein you have a large domestic pool and you are not dependent too much on the exports. So consumption makes up roughly 55 to 60% of our India GDP. The interesting part is that if you look at the number of affluent Indian consumers, from 20 million in 2011, we have reached around 60 million in 2023. Now, this number will reach almost 100 million people in the next 4 years, or rather in the next 36 months. Now, having almost 100 million affluent consumers in India is something I would say incomparable with anywhere else in the world. You have very few countries which have a population of that size. Now, I'm talking about almost 100 million affluent consumers. Now, what is affluent consumers? Affluent consumers are basically the people who have your per annum income of more than $10,000. I know it looks very small for most of us on this call, but $10,000 per annum income is what defines affluent category, and that is where a lot of consumption happens. Now, the interesting part is the behavior of consumption changes as your income grows. Now, what you see over here on the right hand side is as your income grows, your expenditures happen more on the consumer discretionary side and much less on the basic amenities. When your income is less, almost 50% of your expense happens on the basic amenities. As your income grows, you spend more and more on the consumer discretionary needs. And that is where I would say sectors like auto and auto ancillary, sectors like the real estate and ancillary, sectors like consumer discretionary, wherein you can say the malls, the retail, hotels, hospitality, aviation. These are the sectors wherein you'll find a lot of growth happening. So within the consumption basket, you will find a lot of growth happening in all these sectors, as I mentioned. Just to give you a glimpse of how numbers change, and if I look at the number of the demat accounts, I think why I'm focusing on demat accounts, because that gets the maximum media attention. From almost 21 million demat accounts in FY13, in the last 10-11 years that number has gone up 7 times, and that gives you an indication of the amount of disposable income, the amount of money which domestic consumers and domestic investors have been having. If you look at the number of the credit cards, it has doubled in the last 4 or 5 years. If you look at the number of home loans, that has almost given you a 80% jump in the last 24 to 36 months. So these are kind of the numbers which will lead to the next part of sectors which I'm bullish on, which I'll come to after this. In this slide, what you see is that it's not only the top category of Indians which are seeing the highest growth. There's a lot of discussion which happens that you are seeing a lot of disparity of growth in India. The top 1% is seeing its wealth growing and the bottom is not growing. I would say yes, bottom might be not growing at that pace, but the middle part of India is definitely seeing a large growth, and this is seen in the numbers. These are basically within the same categories. We have put a slightly premium brand and we have put kind of the mass market. So you're seeing a growth in both premium and the mass market. Something like the Zara, which is a premium category, and the V-Mart, which is the mass market. Again, if you look at within the four-wheelers, we have put the growth for Jaguar, and also we have put in the growth for Mahindra and the Maruti, which are the mass market. So you are seeing a growth across the spectrum. It's not just that the premium category is growing, you're seeing a growth across the premium and the mass market. So this brings me to the third part of the sectors where I'm bullish on, which goes without saying, which is the backbone of any economy. So financials becomes the backbone for both manufacturing and the consumption. So why consumption? Because why financials? Because as I mentioned in the earlier slide, with the number of demat accounts opening, I would say financialization of savings is a massive transformation which is happening. So historically, we Indians, we saved money in fixed deposits, gold, the real estate. This used to be the traditional. A lot of that is now getting, I would say, moving into the financial market. Even after the massive jump in the financial markets in the last 4 years, if you look at the numbers, we are still way below what others are. India stands at India's MF industries AUM is roughly around 18% of the GDP, which compares to almost 56% for the rest of the world. And if I obviously within that 56%, you will have an aberration of the US market. If I remove that, even for the Chinese market, which is around 23%, Hong Kong at 28%, the UK market at 53%, we have a decent headroom for growth on the financial side. If I talk about the lending growth, as I said, India's domestic credit increased by almost 11% in April, and that compares to a similar number in the earlier years. Interesting part is we don't need to follow the rest of the world, how they have moved on the financial growth. India has adopted the fintech, and we all know about the UPI, we all know about the digital payments. I think our migration to the next level of digital growth on the financial side is much ahead than the rest of the world. And if you look at the numbers, it speaks for itself. The amount of value which has been transacted on the UPI, that gives you an indication that where the growth is going to come from. In this slide, I just put in some of the parameters because I just keep getting a lot of questions on which are the parameters and the drivers of different sectors, and where we find that where we see that the big drivers will be coming from. So these are different indicators or drivers or the variables of the sectors where I keep looking for, where me and my team at Quest we keep looking for. There is no, I would say, the magic formula to look at any sectors. You need to keep observing across your the economy and where you see those inflection points, and that is the point you kind of start getting into those. So that's broadly from my end. I try to keep it as brief as possible in the last half an hour, and will be more than happy to answer any questions from the audience. Over to you, Akshara.
Yeah, thank you, sir. Thanks a lot. And of course, this was a very brief presentation, and just it did justify the topic. And we knew like why India is moving towards $5 trillion economy. So thank you for that, sir. To start off with, let us start off with a market question where we all of us know the markets are at all-time high, and we see new highs every time. So we are in a section where people are booking out profits. So how do you see the market now?
So this brings me to a question which again, always people ask that is it a good time to invest? I think there is no good time and bad time to invest. It all depends on your investment horizon. Now, if your horizon is 6 months, definitely markets are very expensive. If your investment horizon is going to be 6 years, I think you don't have a better time to invest than now. Talking about valuations, I think if you look at the headline index, like we talk about the 1 year forward Nifty valuations, we are right now at around one standard deviation on the 1 year forward valuation. And that is not a very expensive number. Even if I look at the price to book, we are at an historic mean of the last 15 years. On a 1 year forward price to book, we are at the historic mean. So, and this I'm talking about the large cap index, which is the Nifty. If I look at the small cap index and the mid cap index, yes, we are at a slightly expensive valuation compared to the large cap index. But then that is where the real active management happens. And, which I mentioned in the first part of my discussion about active management. Idea is that the whole market is not expensive, or the whole small cap basket is not expensive. There are definitely many pockets within the small caps which are attractively priced. In fact, in the last 4 months, we would have bought multiple small cap companies, and this was against the consensus that small caps are expensive. And each of those small caps have given us almost like 40-50% return in the last couple of months. So I would say that there are definitely opportunity in the market. You can't be out of the market. You have to be very selective what you're buying. More important part is don't buy into anything which has become the hot company or the hot sector or the hot company of the day. Be away from that. Valuations in some parts of market are over the edge, and that is where I would avoid.
Okay, so we'll take one question from the audience. The very first question was from I don't know, the person has not mentioned his name. So a good data point. Share your view on high global debt, which can go slow growth as people will look for safety than growth. Do you think we are in high growth, high inflation era for next couple of years?
See, answering this question, I'll mention that a large part of this has to be driven from what happens in the US elections. Because if you see in this year, almost 60% of the world population is going for elections. And I believe that India is going to be the only country where you will see a continuity of the government. We already saw what happened in France. We saw what happened in UK. And with the way the things are going in the US, I think definitely you will see Mr. Trump coming back. Now, with Mr. Trump coming back, my view is that he will want the dollar to be weak, because he talks about make in America, and for him, make in America, for that dollar needs to be weak. So I would say that debt and equity, they will go hand in hand. We have heard this debate about in fact, if you see in the last 4 years, interest rates in the US has gone up by 450 bips. In spite of that, equities have done exceptionally well. Now, when interest rates go down, definitely equities will continue to do well. So there's no reason to believe that you will find that equity not doing well, both on a global and on an Indian side. I think we are in an era wherein inflation. You spoke about high growth and high inflation for the next couple of years. I think inflation. I think the new normal is what we are at. We can't look at very low inflation. I think for the last 24 months, or rather last 18 to 24 months, both the US Fed and the Indian or different bankers of the central government in different countries, they've been talking about inflation to be brought down. But I think everyone has understood this is the new normal. So I think having inflation at where it is today is will continue, and I think growth is going to pick up. So growth and inflation will go hand in hand.
Okay, so thank you for that. And one question, the next event, what everyone predicts is budget that's coming up. So, and there's one major event of, as once you said in a PPT also, developed nation by 2047. So what are your views on it? If I could ask you.
I couldn't hear you that part.
And the next major event in the market is the budget. Right. So, as you mentioned, one of your PPTs, you just said that by 2047, we expect to be a developed nation. So, what are your views on it?
See, I would say that budget in this year, at least, this is going to be something wherein government will support both welfare and Capex building. And I would say government has a lot of support from the fiscal deficit, because the large RBI dividend which came, that gives them a large room to continue to balance both welfare and the economy. So I don't see any negative surprise in the budget. There is no reason to be negative on the budget. I think you will find more positive surprises. There could be more policy announcements on the Capex building, infra side, defense, railways, because all of this ultimately will lead to the job creation. Because I think job creation has been a major concern for the government. Even the opposition has made that as a big kind of a factor during the election. So I think job creation being at the top of the mind, they will look at a lot of those infra spends. Along with that, I think there could be some tax benefits for the middle class also, which will again, I would say, boost the domestic consumption. Consumption being one of my broad sectors, I think tax benefits on the middle class will boost consumption.
Okay.
So I'm very positive from the budget.
So are we, sir. So next question from Avadani is that valuation sector cycle, how are they related? And how could you draw correlation between them?
See, basically, as I mentioned, business cycles, they lead to earning cycles, and earning cycles, they lead to the valuation cycle. Now, what it means is that basically at the bottom of a business cycle, say, for example, you take up the IT sector. Now, why I'm talking about IT sector? Because in the last 4 years, we have seen it going from bad to good to average, and then now coming back. Now, at the bottom of the business cycle, if I just see before the COVID, IT was going through a bad patch. And that was the time you had your earnings also very weak. And that was the time you had the multiples for all these companies being very low. So that was basically a business cycle being weak, earning cycles being weak, and valuations was very cheap. Post March 2020, as you saw in the next 6 months, massive growth in the IT demand, because with everyone wanting to migrate to the cloud, with businesses moving to the cloud, with a large pipeline of deals for the large, mid, and small IT companies in India. Along with that, improvement in their margins, because employees were not required to travel overseas; everything was happening from work from home. You had the both benefits of large pipeline of deal execution happening and also margin improvement. So that was the business cycle which picked up. That got reflected in the earnings cycle. You saw the earnings of companies of across the IT spectrum going up multifold, and that got reflected in the valuations. So valuations had also reached almost that 10-year peak. Now, just to give you an example, companies like Tata Elxsi, when we had got into that, our initial entry was at around 600, at 900, even at 1100 we had bought in. Now that was the bottom of the business cycle. As earnings picked up, and that time the multiples used to be around 18-20. Now, when the earnings started picking up, because all the verticals of Tata Elxsi was doing exceptionally well during the COVID, the three verticals being your autos, media, and healthcare, earnings went up almost like 30-35% was kind of the growth, and which you can't expect in IT companies in India. And that was time you saw the business cycle picking up, earnings picking up, and multiples went up to 60-70p. So from 20p, you saw 60p. So that is the kind of the relation between valuations and the sectoral upcycles.
Yeah. Thank you, sir. I think
I mentioned Tata Elxsi, so that should not be seen as a recommendation. That was an old example.
Got it, sir. And the one more question from Akhilesh is that, what is your opinion on logistics sectors and e-commerce industry?
See, the logistics is something I have been quite bullish. And the reason being that if you're talking about a lot of domestic consumption, it involves transport of goods and services within the boundaries of the country. If you're talking about India becoming a manufacturing hub, it talks about a lot of movement of goods from the borders of India to the rest of the world. So logistics from both inland and also overseas is what I'm very bullish on. In that space, definitely the number of names which are there are very few. So you need to balance both the good quality companies from the average companies. And I think as a sector, logistics, I'm very bullish on.
When you talk about sectors, let us talk about pharma and IT, which is a new entrant to your portfolios now. So why was it? Just now Quest has become bullish to these two sectors.
In fact, just to take your glimpse through pharma and IT, because both of these used to make up almost 40% of my portfolio in the COVID. So during calendar year 2020 and 2021, pharma and IT collectively was almost 40% in my portfolio, around 35 to 40% in my portfolio. Now, for obvious reasons, that time was a good time for pharma doing well, multiples expansion, earnings growth, and also the same for the IT. From calendar year 22, as the valuations had become rich, I started decreasing allocation. By end of calendar year 22, and by, I would say, the first half of calendar year 23, my exposure into pharma and IT had gone down to zero. So I didn't have a single IT stock. I didn't have a single exposure into the healthcare. Over the last 4 months, we have been adding into both pharma and IT. Now, the reason for that is that I think both of them have gone through that massive phase of time correction, which has led to a lot of valuation correction. Also, margins have bottomed out, margins have started improving both for pharma and IT. If I talk about the IT sector in particular, because that happens to be the hot sector for this week with a lot of earnings season which has come, I think you have seen a lot of movements in IT sector. I think in the IT sector, margins have bottomed out from being an employees market. It has again become an employers market. You are seeing a lot of pipeline of deals which was getting postponed. That is seeing a lot of execution happening. And I would say even attrition, which was a big concern, had gone up to almost 18-20% earlier. That has also gone down to 13-14% now. So I think all the headwinds have now gone away from the sector. Yes, I would not say that everything in the IT sector looks very good. Yes, there are some pockets which are still not doing very well. But yes, I think you can't wait for everything to turn good and then enter. Otherwise, you'll have to pay a premium for it. So I think it's a time wherein that's the reason for the last 4 months we have been buying into IT and pharma both. Pharma also because I think impact on the US pricing, domestic pricing, and also approvals from the US FDA, everything has kind of improved a lot.
No, sir, but in one hand, we will talk about West increasing its exposure to IT and pharma. In other hand, there is sectors where you have no exposure, like FMGC, consumer durables, metals and mining. But these sectors are also poised to do good this fiscal year. And why there's no exposure to these sectors?
See, metals is one sector very difficult to catch it because metals, I think, practically just 1% of the population, or when I say population, 1% of the investing population are able to catch the metal sector at the right time. And I would be happy to say I'm not in that 1%. The reason being that metal prices are driven by multiple factors on the global side, and China being a major driver of metal prices. That, because you have almost 70% of metal production happening in China. So, and also the consumption of almost 70 to 80% happening there. So they always remain a large driving factor. Domestically, yes, India is manufacturing its own metals. And also, I would say that with a lot of infra projects, metals will do well. But that is something as a house we have decided to avoid. FMCG, I am not averse. During COVID, I had a decent allocation towards FMCG. As valuations became expensive, we moved out of FMCG into urban consumption. As of now, I would say we have started looking at FMCG companies. And when I'm saying FMCG, they are basically the consumer staples, because that is where the agri consumption comes into play. So as I would say the income growth happens on the agri side of the economy, we are looking at FMCG companies also. Volume growth is something which we are looking for as an indicator, and only that will give us comfort that the sector is out of the woods.
And also, when you see the markets are quite expensive now, and we could see fund managers shifting their portfolio more towards large cap, and still we could see that in your portfolio you've given more of weightage to small and mid caps. Do you see some opportunities coming up there?
In fact, whenever I see investors, everyone going towards one side, that gets me more concerned. And in fact, if I see the last 100 days, almost every commentary I see is that be away from small caps, decrease your exposure to small caps, get into the large caps. Now, the problem with that is if everyone gets into the large caps and everyone dumps the small caps will become very attractive very fast because the price correction in small caps happen very fast. Now, having said that, it's not that everything will fall in the small cap. Anything which is over owned or where the valuations are very expensive in the small cap, that I would always avoid. But within that basket, there are names wherein we have actually increased our small cap allocations because when the panic was there in the month of April, we saw a lot of good small cap companies getting sold at any price. So I actually increased my small cap allocation in the month of April. So opportunity comes wherein that there is panic. Next 100 days, don't be surprised you find some similar type of opportunity in the small caps again. And I would be happy to increase my allocation in the small cap that time also. But I would say it is very case to case basis. It's not that I would go and buy a basket.
And when you talk about your performance, like flagship and multi, have given stellar returns in last 1 year. So what do you think would have drive this alpha?
See, I would say both our products, the flagship PMS and the multi PMS, both have a decent history. Now, if I go back and see, flagship PMS was the first PMS which we had launched in 2007, and that has a 17-year kind of a track record. And over this period, it has a decent 6-7% alpha. If I look at the multi PMS, Quest multi PMS, that also has you can say the 10-year track record. And that also has a 7.5% kind of an alpha over a period of time. If I come back to the last 1 year, I would say the two things which has worked well is being overweight on urban consumption, avoiding the rural consumption, and secondly, being underweight on IT. So these are the two things which I would say has done well for us. The third, if I may add, was being bullish on the whole industrials part of the economy, and which includes your power, energy, and the logistics.
So how have you positioned both of your strategies next 6 months?
So I would say what I spoke about in the presentation about the sectors where we are seeing a lot of growth. Now, these three broadly, your industrials and manufacturing makes up almost 30% of my portfolio. The consumption makes up almost 35% of my portfolio, which is 65%, and financials makes up around another 22 to 25% of the portfolio. So practically 90% of my portfolio is between these, which is your consumption, industrials, and financials. I don't see that changing in the next 6 months.
Okay. So the topic is sector rotation. So we got to know that you are bullish on manufacturing and industry, financials, etc. But is there any parameters that you look into if you want to exit one sector?
It's a good question because typically exiting a company or a sector is the more difficult job. It becomes difficult both if you're making profit and if you're making loss. If you're making loss, definitely investors don't like to book a loss. If you're making profit, typically you think that if I exit, what if it moves up more? So it's a very difficult call to exit from a company or a sector. Now, the approach which I would say is what we take is we don't exit at one go. We gradually decrease the allocation, or I would say it is called the weight management. Suppose we have a 10-15% allocation into a particular industry, and gradually we are seeing the sector or the industry is getting overvalued. It's not that 15% at one shot will be sold. We'll bring it down to 12 to 8 to 6, and then gradually will decrease. If I just give you an example again, the IT sector used to be around 20-21% in my portfolio till the end of calendar 21. So December 21, my weightage was almost 20-21%. By the next 6 months, we brought it down to 14%. And by the next 6 months, it was down to almost the low single digits. So from 20, it went down to the low single digits over a period of time. And that is the gradual exit from the sector. So it's not that at one shot you will want to exit everything.
And Quest is one of the few AMCs or fund manager to give allocation to new age companies like Zomato. You found it a bit earlier. So what are the parameters to find such things?
See, the good part of the new age companies is that they actually give you a good insight of where the growth is going to come from. Now, if I see in the case of Zomato, when the company had got listed, in that same period, there were 4 or 5 companies which got listed in the new age companies. You had Policy Bazaar, you had Paytm, you had the Nykaa, you had Zomato, you had the MapMy India. So these 5 companies, they got listed within a short span of time. Now, all of those were the new age companies. Now, many of our investors used to ask us that, out of these 5, which are the ones which you're going to buy? Now, if you ask me what I would see that, out of these companies, which has a moat wherein entry barriers are very high. Now, out of these 4 or 5 companies, we found the Zomato had the highest entry barriers. Now, for me to get into a new age company, it should be a business which has a very high entry barrier. It should be a business which can become profitable, because most of the new age companies are not profitable.
Yeah.
It should have a business which can become profitable. Now, for us, Zomato was a very clear business, because with the number of customers being and also it being a kind of the largest player in an oligopoly business, all it had to do was to increase the per order charges. And that is what is happening as consumers like you and me are ordering on Zomato. They are increasing the charges, and every 1 rupee which they charge extra, it goes into their EBITDA. So I think that is something which gave us excitement in that company, and that is something which I look for any other new age companies which gets listed in the future. Does that company has a very high entry barrier?
Okay.
Because ultimately, when you are unlisted, you get a lot of PE funding, and that leads to your valuations being high. The real test happens when you get listed, because you have to make profits, and if you have very low entry barriers, you can't make profits because others will eat into your market.
True. And when you talk about investor sentiment towards stock picking or stock profit booking, these days investors are very well informed about equity markets, and they can whenever they fund or their portfolio is getting underperformed, the panic they have between themselves is huge. So how have you handled it?
I have been addressing this I'll give you a small background to it. In the last, so when I meet with investors, you get 2 different types of investors. One set of investors is who have been there in the market before COVID, and one set of investors is who have entered after COVID. Now, the people who have entered, who have been there in the market before COVID, could be even like, last 10 years, 20 years, 30 years. They have seen the markets go through the cycles. So they are much less, they will be kind of much less panicky when you see a fall. People who have entered the market in the last 4 or 5 years, they have only seen the market going up. So whenever there is a small correction in the market, like say, 1,000 points decline on the Nifty, they are the ones who get panicky a lot. So most of our questions come from investors who have entered the market in the last 4 or 5 years, because they have always seen the market go up, and that's the concern. Now, how I would address that is that if I look at a market, in fact, any investors who are allocating money to any portfolio manager, you should give them a 4 or 5 year period, because that's a period wherein you will see the portfolio style to play out. Because it's not that every year somebody will be the best performing, and ultimately you cannot keep investing into the best performing manager, because you have to look at his philosophy and style. You have to look at the underlying process which the fund manager is deploying, and then you have to take a view that does that philosophy and style make sense in the market over a period of time. So you have to give a 4 or 5 year period for the portfolio manager to give you the alpha. Anyway, I'm not saying 5 year is the entire period. So anyway, between 36 months to 60 months is an ideal time you should remain invested with a portfolio to get the real kind of play out on the philosophy and style.
So once, if you want to get the taste of compounding, you should stay invested longer. That's what.
Yeah. So I would say that. So I would say that you need to be there for at least 36 to 48 months to get the benefit. Also, you need to be there in the market, as I mentioned. In my initial style, active management has become a very key factor in building alpha, and that takes care of. In fact, as a house, we have been a believer of active management. And when I say active management, it should not be seen as we keep buying, selling every day. We don't do that. We don't believe in that, and we don't advise that. When I say active management, it is about being there in the right sector at the right time, getting out of sectors when things look overheated, getting out of companies when they look overheated, and looking at places where market is not bullish on, because you can't be buying into what everyone is buying into.
Got it. Thank you, sir. With that, we've come to the end of the session. It was a very insightful one. I think 1 hour was too less to know about it. We have got more questions falling onto the chat box, Q&A box as well. So these questions will be mailed to you. So
Sure.
kindly take some time for to answer these questions.
Sure.
So
So thanks to all the audience for having us with you on this evening.
Thank you all for staying up, and thank you so for attending this.